So I appreciate everyone being here, and really tonight is all about all of you. You're what have made this company as grow the way it has, and we really appreciate and we're grateful for all of your business. And so we wanted to celebrate you tonight with this dinner. So really tonight it's just about you enjoying the dinner. We do have a good speaker that's going to talk about the economy and the markets. He's a financial analyst. He actually picks all of the 50 stocks in the Gradient 50 investment that we do with a lot of our clients. And so you'll hear what he has to think about the markets going forward. So we're going to hear from him. We're going to have a little break after he speaks. And then I'm going to come up and tell you what I think about the markets, which might be a little bit different. I'm also going to tell you what I think about the Trump election. I'm not going to hold anything back. And I'm going to pick on him as much as I'm going to say that I like some of the stuff he's doing as well. But we'll talk a little bit about that, and then we'll kind of wrap up the night from there. So a few things I wanted to cover, and I got a little cheat sheet here. I want to make sure that we acknowledge some of the sponsors that helped us put this on. They wanted to be part of this, and so they're companies that we do a lot of business with, and so we want to acknowledge all those people, which I'll do here in just a second. And I also want to acknowledge the fact that we have grown quite a bit. Obviously, you can tell from the size of the room. We have advisors in the office. They're working with a lot of clients. Between the assets under management, the insured investments, the alternatives, everything we do, we're up around $700 million of total assets that we are responsible for. So it's a big number. And what we want to do going forward is we really want to focus on improving our customer service. And so 2025 is going to be more about how we can provide better service for all of you. We're going to slow down a lot of the marketing. We're going to slow down a lot of the growing the business and more focus on how we can improve our business. So we've actually taken some steps to do that. We've implemented minimums. So currently it's at 50,000. It's probably going to go up from there. So any new person who wants to work with us is going to have to come in with a larger chunk of money. I've always had the attitude that I want to help everyone. I don't care how much money they have. I don't care if they're $100,000 in credit card debt. I want to help them. But we just can't do that. We're going to run ourselves too thin. So we've put some minimums in, and we're going to start raising those. And so over time, we'll probably raise those minimums. It will not affect anyone here, okay? So if you do not meet any of those minimums, once we hit that point, you're good to go. You're going to stay as a client forever. We're never going to let any of you go. But we do have to kind of restrict new people coming in because of the growth. And so one of the other things, too, is we want to focus on time management. Some of the tasks that are easy, for example, like a buffered index portfolio, if we're going to renew it for someone, or maybe it's an annuity that's coming up for maturity and we want to put it in a new investment at a higher rate. We're probably going to have other advisors, which we're bringing on board to help us with that. So some of the easy stuff, I don't need to meet with everyone every time they come in for all the little stuff. So we want to try to focus on being as efficient as possible. So we're doing that. And one thing that we did, which I think has been a great, great move, and I want to really acknowledge him. He's been with the firm now for about 6 months. And he was originally at TD Ameritrade and then Charles Schwab when they made the merger. He actually was there for 23 years, and he now has come on board with us. He's now our Director of Operations here at Copley Financial Group. So Alan Bunce, if you can stand up. Everyone know who Alan is back in the back there? So Alan is heading up really creating this efficiency, making this a better company, making it a better client experience. He has the experience at TD Ameritrade, which they did a great job. And since Alan left TD Ameritrade, Schwab hasn't done such a great job. So I think he was a big part of that. No, they're getting better. So Schwab is getting better. We went through a lot of challenges on the merger between TD and Schwab. But we're very, very happy to have Alan here with us, and he's doing a great job in the office, creating a lot of efficiency. We got some new software programs that are going in, and there's some neat stuff happening. And I'll tell you one thing that I'm excited about that's coming and that's in artificial intelligence. And of course, we just had some big news that the new Chinese company is doing things better than the American companies. And so NVIDIA stock dropped 17% in one day, and it's been challenged. Gee, I thought I heard a video a couple months ago about how NVIDIA was too high and it was going to crash. Did anyone hear that video? Yeah, I told you it was going to happen. You can't keep an 80% profit margin for that long. And it reminded me just of Cisco Systems back in the year 2000. And so NVIDIA's not going anywhere. It's a great company. They're making lots of chips, and they're going to be part of this AI future. They were just overpriced. They were overvalued. So they just needed something to cause their stock price to crash. And so I really do think this AI is real. And what DeepSeek is doing is very, very interesting. It's kind of, I'm sure the people in Silicon Valley are probably kicking themselves thinking, why didn't I think of that? What they did is something a little bit different. All the Silicon Valley companies that are like OpenAI and ChatGPT, they basically have training models that are teaching them on the entire internet. So their AI systems are learning the entire internet. And this is obviously takes a lot of power. And when they're doing queries, they're actually looking at all of the data on the internet. And so I don't know, maybe I watch too many Terminator movies, but this is probably not a good idea to train a computer on the entire knowledge of the internet. But what the Chinese are doing is a little bit different. They're creating experts inside of that AI. So when you do a query with the new Chinese company, they're just going to that AI expert. So if you're searching something up on engineering, they're going to go to that expert on engineering. They don't have to run all the searches for, the best skiing in the Alps, right? And it's a completely different subject. So it really, I think, is going to be a big deal. How we're using AI, which is going to be interesting coming up here in a few months. We're actually working with a company. We're going to bring them on board. And what they do is it's an AI assistant. And so what we'll be able to do is literally have it on our phone. And whenever we have a meeting with a client, we can literally push a button. And this AI is going to listen to the entire meeting, and it's going to create a summary. And this is a summary that's going to say, here are the bullet points. Here are the things that we wanted to accomplish in the meeting. We want to move these funds here. We want to do this. We want to create income. And we want to, and what it's going to do is it's going to create a summary for not just us to be able to be a better financial advisor, but we're going to give you a copy of the summary so you can see exactly what transpired in the meeting, what the plan was. And so this is some of the things that we see going forward with AI that I think is going to be very, very, very powerful. So I will come up and tell you what I think about the markets and everything else going forward and Trump. But first, before I bring up Jeremy Bryan, I want to mention all these people here that are help sponsoring. So you've got them up on the board there. These are all the people that help put this on. They help pay for tonight. So these are all important people. And so the first one I'm going to mention is the company NextPoint. NextPoint, Sean Parvin, Kyle Banky, and Brian Graham. Can you guys stand up? I know Sean's here. I saw Sean. There they are in the back there. So NextPoint, this company is the one that's responsible for that 5.5% guaranteed interest rate, the insured interest rate that a lot of you guys are doing. So if you want to talk to them about that, they're the reason that we were able to negotiate that good rate. So for those of you that have that guaranteed 5.5%, that's net to you. And so it's a really good product. It's a great alternative to putting your money in investments that have risk. Hey, if you can get 5.5% with no risk, it's not a bad deal. And they also have some other investments for accredited investors, things that we're doing with 1031 exchanges, DSTs. They had the project up there in Temecula, the chip factory, that Scorpio's chip factory. They're building the 300 wafer chips. So that's a great project for real estate people that are selling an apartment building or a rental property, a house or a condo. They can go into that investment. So I wanted to recognize NextPoint. Also here is Inspired Healthcare. Sly Parasiri, if you can stand up, Sly, in the back there. And so some of you guys are with Inspired Healthcare. You've been working with them. They obviously have some of the 1031 and DST investments. They also have the income fund. That's the one that pays 12% guaranteed interest. It is paid by the company, so this isn't FDIC insured or insured by an insurance company like the 5.5 is, but 12% is a really good interest rate, and they're a great company. They work all over the country working with assisted living and memory care facilities. So that is a company that we've been working with quite a bit. Also here is Todd Woodhead with Walton. So if Todd, where are you at? Todd's over here. So this is kind of a newer company that we started working with. And what they do is very interesting. They actually are the ones that get in front of all of these companies like Pulte and D.R. Horton and Lennar that build new homes. What this company does is they go in and find the properties, get them all ready, and then once they acquire the properties, the ones that are getting ready to be built, then they negotiate with these builders, and these builders come in and actually build the properties. So these guys are kind of the ones that get everything started on the new communities, get everything set up, get it ready, figure out the zoning, the whole bit. And this company has been getting 18 to 25% returns on their investments. It is a longer-term holding that you hold for 2 to 6 years, but we're really happy to work with them. It's one that we definitely want to take a look at. It's for growth. They also accept 1031 DST money for people that are selling property, being able to transfer it. In addition to Walton, we have here RGP. So Paul Garvin and Brandy Van Loon, can you stand up? I think you guys are in the back. There they are. There's Paul and Brandy. And they are our favorite oil and gas investment right now. They have a great project. It actually paid, and for those of you that were in it last year, 13% return for the year, which was great. And this is oil and natural gas. And people say, well, gee, Matt, why do you want to invest in that? Aren't we all going to drive Teslas? Well, I think that we still need the oil and gas. And if this AI thing actually works out, they're going to need a lot more energy because all these data centers and everything else are taking a lot of energy. And they say, oh, well, the Chinese companies, 20% of the energy use is the American companies. So, yeah, they're just going to make better AI systems. That's how they're going to do it. They're going to continue to use the energy. So it's a great company. And one of the things that they do is you get a big tax break. Because it's an oil and gas investment, they have this intangible drilling costs and these depreciation up front. You get a big tax break up front. So we've been using it a lot for clients that are interested in tax reduction. In addition to RGP, we have here Keystone, Mike Packman. I think you're in the back there somewhere. There's Mike back there. Mike is a wealth of knowledge. Mike is an expert on tax reduction. They do a lot of charitable investments where we can get some very big deductions if it goes to charity on our tax returns. Mike actually works with a lot of family offices and really wealthy. I'm talking multi-million-dollar families around the country. He flies his private jet around the country and meets with some very, very wealthy people doing tax reduction. So if you get a chance to talk to Mike, a wealth of knowledge on tax reduction. So that was Mike Packman. In addition, we have, by the way, Mike does have some 1031 DST investments as well. We were in that FedEx investment here recently. It worked out great. Some of you were in that. So in addition to Keystone, we also have Sandy Bay. Sandy Bay does not have a representative here tonight, but Sandy Bay does a lot of the same tax reduction investments, and they did sponsor this. They gave us some money to pay for tonight, so we definitely want to recognize them. But if you're interested at all in any of the Sandy Bay investments involving tax reduction, they have a lot of coal mines that they turn into charitable to donate it for nature and getting a big tax deduction on your taxes. So if you need more information on that, just talk to your advisor, and they'll be able to help you with that. So the one person that I did not recognize yet is the one that we're going to bring up to speak, and that is Jeremy Bryan with Gradient Investments. And Gradient has been really a big part of our business and helping us grow. They have a team of CFPs and financial analysts that helped us really early on. They helped us build the business. They've had some really, really good investment advice. They helped us set up a lot of the structure within the office. Not only that, they have some really good investments. In fact, my favorite investment is the one with Gradient, is the Buffered Index Portfolio. So the Buffered Index Portfolio is the one where you can go into the stock market and make money up to a cap. And so the one we have available right now is a 19.25 cap. So you go in the S&P 500, you can make money up to 19.25 over the next 2 years. And in the event the stock market is higher than 19.25, then you just get 19.25. So if the market was up 30%, you'd only be up 19.25. So we're agreeing to give up everything above that cap in return. So, but if the market's up 15, you're up 15. If the market's up 19, you're up 19. But if the market's up 40%, you're only going to be up 19. Now, in exchange for giving up everything above, we're able to buy insurance on the market. And I think that is so important right now, especially with current market valuations. We're able to get a 20% insurance policy. So in the event the market drops, not only do we not lose any money, we actually make the inverse return all the way down to 20%. So if the market was down, say, 12%, not only do you not lose, you make 12%. You make the opposite return all the way down to 20. In the event the stock market's down more than 20%, you just get a reimbursement. So you can lose money on this investment. If the stock market was down 25%, you'd get reimbursed 20% of that loss. You'd still be down 5%. But this is a really good way to take advantage of rising stock prices, making money in the market, and in case things go really bad, you get a huge reimbursement to protect your investments. This is super important in the current market environment, and it is super important for people that are retired that I don't want to have to tell you have to go back to work. So we want to protect the principal. That's more important than these big returns. So and by the way, if you get 19% over the next 2 years, are you going to be unhappy? No, that's enough. I'm not greedy. I don't need any more. So it's a great investment. So Gradient's the one behind that. They help us negotiate it all with the banks and get all those numbers. In addition, Gradient has the G50, which has been a big part of a lot of the investments we have for our clients. And those are their 50 favorite blue chip value stocks. These are companies that we all know that pay good income stream, good dividends, and they buy them at the right time. They know who to buy them. And the person that is responsible for picking those 50 companies is Jeremy Bryan. So we're going to hear what he has to say about the markets. So Jeremy, if you can come up, we'll get Jeremy introduced here. And what will happen is once Jeremy is all done speaking, we're going to do a little break. And then what we'll do is I'll come up maybe 15 minutes or so after, or 20 minutes after the break. So if we can all give a round of applause for Jeremy Bryan.
Hello, everyone. So first off, I come up after Matt. You're all going to have to look down a little bit, clearly. So sorry about that. Let's start with that. The other one is Matt took all my AI stuff, so I'll probably just spend that last 10 minutes talking about the Padres or something. Last thing is what'll be really interesting is Matt, as he said before, he's going to come up after me. He's going to talk about the markets. He's probably going to have maybe some different things to say than I will. I want to relay a story about that because I think it's super interesting. Last year, I was in New York for a little bit, and I went to the JP Morgan symposium. And as part of that, we got to sit with their investment professionals, and we also got to sit with Jamie Dimon, who's the CEO of JP Morgan. So sitting down in that meeting, all of his investment professionals went into highly detailed, really going into the nitty-gritty about what's going on in the markets and what their thoughts were and all that stuff. And Jamie walks on stage and he's like, I don't know what they were talking about, but interest rates are going to 8%. He just blew up everything they had to say. I saw their faces go absolutely white. We're not going to do that. We may disagree. That's absolutely fine. Even companies like JP Morgan are going to disagree on things from time to time. But I do want to relay what we see out there. And so we're going to start with that right now. As you can see, what it says up there is this point forward. I don't have a whole heck of a lot of interest, and I imagine you all don't have a heck of a lot of interest in understanding the history. Let's talk about what we see as this point going forward. So that's why I wanted to put it right on there. So let's start with a very simple analogy. And I apologize in advance for the eye charts that you guys are having to read tonight. I'm just going to tell you what they are. It's absolutely fine. Let's start with GDP trends. So this is GDP, and GDP is a good barometer of what we do in our economy. And if you've ever heard us at Gradient Investments, we follow a stoplight analogy, right? Green, good; yellow, cautious; red, bad. You can see most of the GDP that we've had has been pretty good. You know, mostly green. We have some tough times, but for the most part, we're in green territory. What we pay a lot more attention to is those last three numbers. The last three numbers are the estimates for what people think it's going to grow in the future. And you can see that number's starting to come down. It's starting to come down a little bit, but what don't you see in those estimates right now? Red. I don't think we're in an area right now where recession is on the table. Could I be wrong? Absolutely. Absolutely. But from what we can see at this point right now, and what the companies, more importantly, are telling us, is that things are still going pretty good. And I'm going to show you the reasons why here in a little bit. But why we think things will probably slow down a little, but probably not fall into recessionary territory, is based upon a couple of things. It's one, it's jobs. And that's going to be the biggest thing right now, is I want to talk about jobs to you all. Because I flew in this morning, and I'll fly out tomorrow morning. Those airports are still pretty full. I think this is evidence that people want to still get out and do stuff, right? Here's my very simple philosophy on all this, because you hear a lot in the news about, oh, consumer debt is at the worst possible levels. It's at the highest level it's been. We can't spend anymore. We're tapped out. Here's my thought. If the U.S. consumer has a job or feels like they can get a job, they will continue to spend money. We spend money better than anyone else on the planet. It's probably the thing we do best. And that's great for our economy. 70% of our economy is based upon what we spend. It re-engineers. Service businesses love that we spend money. Those are the kinds of things that we're looking for. So as long as those numbers stay low, 4.2% is incredibly low if you look at long-term history. That number could go up by 1%. It would still be below the 100-year average of unemployment. So I think unemployment at this point right now is in good territory. But this is probably the thing we're tracking the most. And the things we're doing is that if look at those job openings are starting to fall, right? That's why you have that yellow on the job openings there. But what I'll tell you is they were falling off. Do you all remember going to a restaurant where they had to shut down half of it because they couldn't staff it anymore, right? At that time, there were 3 jobs open for every 1 person to fill it. That's not the case anymore. But we're in kind of that 1-to-1 territory. And 1-to-1 territory is absolutely fine. What I would say to you is if you wanted to say, Jeremy, what would you worry about? That would be it. We would be looking at unemployment claims. If that starts to rise, and what I worry about more, because by the time we see actual job cuts, usually these rooms are a little emptier already, and usually those airports are a little emptier already, right? Because people don't stop spending only when they get fired. They stop spending when they're scared they're going to get fired, right? So from our side, we have to make sure that we're paying attention to that because it will reflect in the numbers way after what actually will occur. But what we're seeing right now, and again, what the companies are seeing right now, is that the job situation is still pretty good. So we'll move on to the next slide. I don't know if I hit the button. I'm sorry. There we go. Inflation readings. Is anybody else tired of hearing about inflation? Is anybody else tired of paying for that inflation? Yeah. I'm going to give you my hot take, and I'll be interested in Matt if he feels differently. I believe that number on the top right where it says food price growth is one of the main reasons we have a new president in the office. Nobody likes paying $7 for a carton of eggs. Everybody hates it. They hate it. Inflation is a killer. You will not get reelected in a high inflation environment. You just won't. It just doesn't work that way. People hate having to pay for an aggressive amount more for things. Here's what I always tell people is that when you look at your statements, you've probably, if you're an asset owner, Matt mentioned a lot of different assets, right? You guys probably own a lot of different things, which is great because asset owners probably benefited a little bit from the inflation that we had, a little bit. But nobody feels that way, right? When you open up your statement, you feel good once a quarter. When you go to the grocery store, you feel horrible once a week. It's a very different story, right? So from that side, it's just an area that became unsustainable. And again, from our side, what I worry most about is that top right one. So the Federal Reserve, when they talk about inflation, they take out food prices and they take out energy. Well, those mean a heck of a lot to somebody like me because that takes right out of the consumer's pocketbook, right? So from our side, we're going to pay a ton of attention to those things too. And that's where we're saying if food price growth really starts to reaccelerate and you're starting to see those eggs go up again, I don't know if many of you been to the grocery store, but those eggs are going up again. If that really starts to spiral back up the wrong way, that could be a pretty negative for the overall economy. Because I don't know if we can handle another one in a row. I think we'll get ticked and I think we'll stop spending. We're not there yet, but that's what we're paying a lot of attention to. The other one, I used to say a couple of months ago, or it's a little while ago now, I used to always say you hate talking about it when you're at the grocery store and the gas station. Well, you guys are in California, you probably still have a gas station. But for those of us in flyover territory, the gas station hasn't been as bad, right? Is that actually gas prices have been coming down for some time. But again, if that starts to rear its ugly head again, that's what we would worry about. We're not there yet. But we're going to pay attention to that kind of stuff because both of those act as a tax on consumers. When you have more money that you on the things you have to spend on, like filling up your gas tank and buying eggs, you have less money for the things you want to spend on, which is what drives our economy. So we're going to have to be careful about that. But at this point right now, we're still in okay territory. But people often ask me, it's like, what makes you nervous? Would be those two numbers up on the board there. I'm going to switch to the assets now a little bit. One of the things you're not going to hear from me, and some of you who have been here before have probably seen my boss present. He's, again, one of those tall guys. I'm not one of those. But he has come on. He's a little bit more of the market is going to do this next year. I'm sorry if I disappoint you all. I'm not going to tell you that. Because here's the thing. What do prognosticators of the market typically tell you they're going to do? 8 to 10%, right? Yeah, market's probably going to be up about 8 to 10%. You know what the long-term average of the market is? 8 to 10%. That's why they're telling you that. They're just saying, it's probably going to be around average. But here's the thing. You almost never get average. The market doesn't reward you that way. Sorry. You get up 25, you get up 27, you get down 12, you get 4, you get plus 31, and you average out to 8 to 10%. So I'm going to give you last year. Would I have guessed we were going to do 27% in the S&P 500 last year? No. So I'm not going to sit in front of you right now and tell you exactly what's going to happen with the markets. I'm just not going to do it. I don't think that's the way we operate. I am a planner, and I pay attention to what the markets are. I am not a Swami. I'm not a prognosticator of what the markets are going to do perfectly. But let's talk about them. Bond yields. Here we go. Bond yields are much higher than they were before. This is not 2021. In 2021, you were getting nothing for investing in a treasury. Literally nothing. Inflation was eating you alive. Now, it's a little different story. It's actually pretty decent. Getting 4% from a treasury, it's pretty good. Getting 7, 8% from taking a little bit of more risk in bonds, that's a good area. Now, bonds stunk last year. They weren't very good. They weren't down. It wasn't like 2022, but they returned about 2%. Yay. That's not that great. But that's because interest rates were rising. If we're right that we think interest rates are more stable to probably slightly going down, taking this yield and getting a little price appreciation on top of it makes bonds pretty attractive right now. Are they slam dunk? Are they going to give you that 8 to 10%? I don't know. But what they are is paying you a heck of a lot more than they used to pay you in 2021. So that's a good thing. Now, turning to the stock market. There's a little bit of yin and yang, a little bit of a teeter-totter going on in the stock market right now. And I'm sure Matt's going to hit on the second one much harder than I am, so I'm going to let him do that. But here's the first one, is that if you listen to me, if you ever hear about what I think about what drives the stock market, it's this right here. Corporate earnings growth. How are companies growing? That's the biggest thing we want to know. So this is the S&P 500. We grew 9.5% last year. Now we were up 27% in the markets. They don't always perfectly correlate. Some years we're going to be flat and the markets are going to do great. Some years we're going to be down and the markets are going to do okay. Some years we're going to be up and the markets are going to do poorly. 2022 was a clear example of that. We grew earnings and the stocks were down almost 20%. So on a year-on-year basis, you can't count on this. But over a longer period of time, if the companies are growing, it's a great backdrop for stocks. And that's what we see right now, is that the green of this was the growth we've experienced, 10%. The yellow on this is we're anticipating 15% growth this year. That's what the market is kind of saying. The prognosticators, if you will, is they're going to say, market's probably going to grow 15% off of 10% growth this last year. I don't know, man. That seems like a lot. I would lean more towards having another year like we've had rather than an accelerating year. What strike me as weird here is that we're talking about, those same prognosticators are talking about a slowing overall economy, but earnings are going to grow faster? That doesn't jive well with me. But what I will tell you is the stock market, if that number goes from 15% down to 12, down to 10, down to 8-ish, probably still going to be okay. Companies are still growing. We're going to be just fine. If that number starts to fall to 5, to 0, to negative, that's when there's a problem coming ahead. So again, we're not there right now, which leads us to, again, being relatively optimistic on markets overall because we think the companies are still growing. And that's what we're paying the most attention to. Now, I said it's a bit of a teeter-totter. If you wanted to say, and I'm sure Mr. Copley may actually say this to you, if you want to say, Jeremy, you're a lunatic, the markets are going to have a real difficult time. This is one, I'll give you a bullet on this one for that, is that markets are expensive. There's no question about it. We're paying more for the stocks than we were before. What I will tell you is that this is a terrible timing tool. Saying that the markets are expensive, therefore I'm not going to invest in the markets is a very difficult proposition for you all, especially over the next 6 to 12 months. Markets can always get cheaper. Markets can always get more expensive, especially during those time frames. What this is a good barometer for is I should think about my expectations. If I give you that long-term average of 8 to 10%, like I said before, when I'm paying little for the markets, when markets are cheap, I should probably expect better than that. When I'm at this point right now, when markets are expensive, I should probably expect a little less than that. So maybe that 8 to 10 goes to 5 to 7, right? That's a longer term target. That is how you want to use valuation as an investment mechanism. And just saying, well, it's probably not going to be as good as it was before because I'm buying at more expensive payments right now. But it does not mean that we are in imminent doom and collapse mode. It's just not. Here's what I wanted to give to you all, and I know you can't see any of this, so I'm just going to tell you what it is. Investing at all-time highs. I get asked a lot. So at the end of 2023, coming into 2024, I was asked all the time, Jeremy, we just had a 20% plus year. Markets are at all-time highs. Isn't that, we're at the peak of the summit, aren't we? There's only one way from a peak of a summit, right? It's down. Well, maybe not. And then we went from that, and on those all-time highs, we grew another 25% in the S&P 500. Now, what do you think I'm asked most right now? Hey, we're at the peak of the summit, right? There's only one way to go but down. Not necessarily. Investing at all-time highs, the numbers are in red when you invest at all-time highs versus when you invest at any time in the market. Your performance is actually, over a longer period of time, better because the market keeps going up. over a longer period of time, you'd be fine investing at all-time highs. Does that mean I only want you investing at all-time highs? Absolutely not. Don't do that. But what this is saying that timing things based upon investing at all-time highs is probably going to lead you to more frustration than prosperity. Don't do it. You don't need to. Here's a fun one. So I'm going to pivot now. I was going to talk about AI, but Matt covered most of it. I want to give an opinion on that. But I'm going to start with crypto first, because more and more I'm asked about cryptocurrency. Would I invest in it? What I do with it? How much should I be involved in? And my answer to that is very simple. Why? Why do you want to be invested in it? Let me understand what your reason is. Because most of the reasons end up, some people will talk to you about the technology. They'll get about 2 sentences down, and then it kind of fades out. Most people are saying, well, because it's worked very well. And I'm like, yep, that's right. Okay, I gotcha. Because here's what I want to say. The 5-year performance of Bitcoin. Over 5 years, if you invested in Bitcoin, you would be up over 1,000%. And everybody hears jaws drop on the floor and saying, why didn't I invest in Bitcoin 5 years ago, right? Here's the thing. Remember the other line in this. In the last 5 years, the number of times you would have lost more than half of your money during that period of time, 3. You would have had to weather 3 storms where if you had $1,000, all of a sudden you had $500. If you had $100,000, all of a sudden you had $50. Can you stay the course during that period of time? That's the litmus test of it. One of these times, it was actually down 80% during that period. So you have to understand this will be by far the most volatile thing in your portfolio you own. If you're willing to accept that risk for a small component and saying, I want to give this a shot at maybe the Trump coin, maybe whatever coins that you want to be involved in, maybe that's the next thing. Maybe it is, but just understand the risk you're taking. That's all I'll say from my side. I always get asked, do I invest in it? I do not. I do not want that level of volatility. I'm a stock market investor. I enjoy that component. I understand that a little bit better. But if you all want to do it, I'm open to the possibility, but you have to understand what you're getting involved in. I'll quickly pivot to the AI side because I want to talk NVIDIA with Matt because, I talked about how many times we may be going to disagree. I want to agree with him on this one, is that NVIDIA at some point, and maybe DeepSeek does it, but at some point is going to run into a pretty hard wall. And the reason why I say that is very simple, is right now it's an arms race, right? Everybody's just like, I need chips, I need chips, I need chips, I need chips. AI's cool, AI's cool, AI's cool, right? Eventually they're going to have to figure out what we're going to do with this stuff. Like, what are we going to do? What does AI do? Matt seems to have a couple of ideas. That's great. What are we going to do with this stuff? It has to go from we're just going to build the coolest things and we're going to do horsepower to actual use and efficiency, right? Because we just can't support the level of energy it's going to require if all this cool stuff works out. So from that side, I think NVIDIA, they're just going to get to an area where they're going to be like, I think I have enough chips. Now I got to figure out what to do with them all. And they're the ones that are going to feel that most pain. So I'm a believer in AI, and I think NVIDIA is a phenomenal company. I would be a little cautious, especially if you own a ton of it, to continuing to own a ton of it. Just be a little careful. So I'm going to get to the ending theme. I'm going to try to make it as boilerplate and as easy as possible. Our theme for 2025 is bring an umbrella. Bring an umbrella does not mean it's going to rain. It means you are prepared in case rain occurs. That's what we want you to be. The markets have been phenomenal over the past couple of years. We've all made probably a decent amount of money in there, but we've also hedged some of that risk, which we're absolutely fine in doing, and what we need to continue to be doing in the future. We don't know. Protect some of those gains that you've accrued over the past couple of years. There's a lot of ways to bring an umbrella. Matt has a ton of ideas on how to bring an umbrella to what you all do. Rebalancing, using the buffered index solution, diversifying, not owning everything in crypto and NVIDIA. Those are the kinds of ways that you can bring an umbrella to your own portfolios, and you'll be better off in 2025, in our opinion. Again, I am not calling for doom and gloom. I'm just saying have some protection out there, be safe, protect those gains that you've accrued over the past couple of years. I get a lot of, what about this? Well, what about this? What about that? What about that? It's absolutely fine. This is some of that list, right? Is that it was wars right now. I don't know if anybody really feels the Middle East is done. I certainly don't. I don't know how you all feel about it. But we have ongoing wars going on. We have tariffs. We just got news while I was on the plane today. That'll be something I got to look into a little bit with regard to Mexico and Canada. We've got inflation, the Fed, all this stuff. I only put this list up quickly because I just want to give you this. I've been doing this for 25 years. My boss has been doing it for 35 years. Our team has 120 years of collective experience. There's never been a time where we've all gotten together and you know what? There's really no concerns out there. I think we're all good to go. It doesn't exist. There's always concerns out there. There's always things that are gonna spook the markets. People are irrational. Markets, therefore, are irrational. At some point, one of these things, and probably something I don't have listed on there, is gonna cause some irrationality. How you would get over that is, again, protecting yourself, participating in upside, but also knowing that markets work over time. There will always be concerns. I usually just end up crossing some of this off and putting another one up there. It happens all the time. Next slide, please. This is one I wanted to give you an example of it. It's a little smart alecky. As you can all tell, I'm kind of a smart aleck to begin with, so I'm going to continue on with this. A lot of times I get asked, is the dollar going away? And the dollar's in trouble, and the dollar's dead, and we're going to all have Melania coin or whatever it is. I use this as kind of my example for that, is that the demise of the dollar, these are just headlines. I just pulled headlines. In 2024, the dollar's dead. U.S. dollar supremacy in 2019. The slow and humiliating dollar in 2014. Dollar's dead in 2009. Dollar's dead in 2004. That's 20 years. Did anybody use a dollar today? I don't think it's dead. I think we're going to be okay. I think the dollar's going to be around for a long period of time. Are they going to use other things? Maybe, to a certain extent. But I always say, watch what people do when they're scared. And what do people do when they're scared? They buy dollars and they hold treasuries. I don't think that's changing. So therefore, I don't think the dollar's going away. Here's the dollar index. Do you see demise? Do you see destroyed? I see just fluctuation. And that's what it'll do. Sometimes it's more valuable, sometimes it's less valuable. But at the end of the day, when you pull out George Washington and his dollar and his face on there, I think you're going to be okay, and I think you're going to be able to buy that pack of gum. Eggs, no chance. You got to pull out more. So I'll end quickly here with a couple of things, is that corrections, everybody asks me, do you see a correction happen in the market this year? My answer is absolutely yes. I can't tell you when, and I can't tell you how deep, but it's going to happen because this chart tells you why. I'll explain it simply. The gray bar is the worst performance during the year, and the red bar is the performance at the end of the year. Even in extraordinarily strong markets, we have corrections. 5, 8, 10% corrections happen all the time. They happen almost every year. They're going to happen again. Again, this is how you get paid, is staying the course to earn those 25, 28, 31, 32% returns. You're going to have some negative times during that. It's not going to give you 8 to 10% every year like clockwork. This is my last one. It's the odds of being positive. You've probably seen this before, and I apologize for that, but I've added a little wrinkle to it because I have a new favorite stats on the bottom right, or bottom left. I don't know my left from right, apparently. So percent of positive years is 73%. This goes back to 1928. If you ever call me the casino, you point me to the casino that pays out at 73% odds. I'll drive. All right? We'll go. We'll go right now. The other part of this, though, is the one I like here, is number of all down years. So I can count. So Just the number of red, 26. Number of 20% plus years in the market, 38. And that includes 2024. You are statistically more likely to have a plus 20% year in the stock market than you are to have any negative market at all. And that's where the buffered index comes into play too, because again, you can participate in some of these 73%, but also protect yourself against some of those red numbers going forward. So the odds are in your favor. Staying the course is still the best way to earn your money and earn your objectives over a longer period of time. So with that said, I'm going to end here. Thank you very much. For those who I invest in, I really appreciate it. Take care, everybody.
Thank you, Jeremy. A couple of quick announcements. We're going to take a short break. Matt will be back up at 7:25, and I've also been told that the bar closes at 7:15. It is 7:10. So we'll see you in a few minutes. Matt will be back up at 7:25.
All right. We're going to finish up tonight. I'll tell you what I think about the markets and what we are, I think, looking at going forward. I'll talk a little bit about Trump and what I see, the positives and the negatives. One of the things that I do want to mention when it comes to politics and everything else out there, all of us have a different opinion on politics, so please do not hold any of my opinions against me. I'm telling you what I think. I'm not going to hold anything back. You may have a different opinion. But I'm gonna give Trump praise, and I'm also going to criticize him. What we're seeing, I think, is really a sea change in attitude when it comes to economics. I think the small business optimism index is a big part of that, and we're seeing that really take off. I think that's a positive for the economy. I think it creates a good potential future. Some of the stuff he's doing, like the External Revenue Service, yeah, that's bullshit, okay? We don't tax China or Mexico or Canada. The American people pay tariffs, okay? When you go and buy goods that are made outside the United States, you are going to pay a tariff if those are, you're going to pay a lot more for those if there's a tariff on those goods. So there's a lot of baloney that comes out of Trump's mouth, and so we'll call him out on that. But all in all, I think from an economic standpoint, there is a lot of positive. And the one positive that I see is the efficiency. This is what they're calling DOGE, the Department of Government Efficiency. Now, I think we need an External Revenue Service like we need a hole in the head, because I think in the future what you might see is an IRS and an External Revenue Service, and then they'll tax on both sides, right? Give them an excuse to have two government taxing agencies. So I'm not a big fan of that, but DOGE is a little bit different. This is an agency that actually is going to be looking at the rest of the government, looking for efficiency. And what we've had over the last few years is a complete waste of money. We've seen billions of dollars go out for all kinds of stuff that was completely unnecessary. $100 billion spent on putting high-speed internet into rural areas that they didn't lay a single cable. It was all planning. Billions of dollars to plan. Well, we have this little thing now called Starlink. We don't need to put cables everywhere. We can do it through the satellite. Whenever the government does something, they screw it up. Okay, so I am happy to see some of this efficiency that we're seeing potentially coming down the pike with Trump. I think that there's a lot of possibility that we'll save some money. It won't be so much waste in the government. $7 billion for electric car chargers. We built 4 chargers. 4 for $7 billion. This is crazy. We don't need the government to do any of this stuff. We need the private sector to go out and put this stuff in, and capitalism works, the free markets work. This is what should be happening. So I am going to keep going on Trump, so give me a little bit of time. But while I'm thinking of it, I do want to bring my 2 boys that are here up here on stage just to pick on them. So Tristan and Gavin, if you can come up here. We want to pick on Tristan and Gavin. Come on up on stage. My wife and my daughter are actually at a volleyball tournament. It was kind of a last-minute change. Our daughter plays travel ball, volleyball. So they're doing a tournament in Las Vegas. So they actually got on a plane about the same time everyone was getting here. They were actually getting on a plane to Las Vegas to do a tournament. And my second son, Braden, he's at Ohio State University. And so Buckeyes. And he's in school for economics. He's doing very, very good with that. So he's back in college. And I saw Troy's son here. How'd that go with Notre Dame and Ohio? Oh, sorry. I pick on him because he went to Notre Dame. So Troy's son went to Notre Dame. So I got to tease him a little bit. So Tristan, he's doing the computer engineering, computer software stuff. He's actually working in the office now part-time, helping us develop some new software that we're looking forward to using for the advisors. So that's what Tristan's doing. 20 years old now, big 2-0. So yeah. We got Gavin up here. So he was the number 3 boy up here. He's 17 now. So taller than his 20-year-old brother. How'd that happen? Yeah, I think he just ate better than you. You were kind of picky. You didn't eat too much, a lot of sugar, and he's eating the good stuff. I think that's what happened. So Gavin is getting straight A's in high school. He has not got a single grade other than an A in every single class he's had throughout his high school career so far. So pretty impressive performance. So, all right, I guess I'm picked on you guys enough. Thank you for coming up. All right, so let's talk a little bit about some changes. One of the other things I think is obviously a huge beneficial thing that could happen, and I do think that it's a possibility. We'll see. Politicians do make promises, and oftentimes they're not kept, right? No taxes for you, no taxes for you, no taxes for you, right, to get elected. But the idea of not taxing Social Security, I think, is a really good idea. And Trump has pushed this. He's continued to say it even after getting elected. So we'll see if that comes to fruition. I mean, it's not fair to tax Social Security at all. People are paying tax going in. Now they're paying tax coming out. It's not fair to tax Social Security at all. And so I like that idea. I hope they're able to put something together to allow for no taxes. But it also means that all of the planning that we've done regarding Social Security just got a lot better, okay? Because I've been telling everyone you pay less taxes on your Social Security income, less federal and no state, and you pay a lot in taxes on your IRAs and pensions and annuities and other stuff you might have coming in. So we've always tried to maximize the Social Security income just because you pay less taxes. Well, if we pay no taxes, it just got even better, okay? So all of the stuff that we've been doing is a huge positive if we get no taxes on Social Security. We'll see how that plays out. Again, I'm not holding my breath because politicians make promises. We'll see if they actually get to keep it. One other thing that recently happened, there's a bipartisan bill that actually passed before Trump took office, and that was to get rid of the government pension offset and the windfall elimination provision. That's great news for all of the teachers and the people that were collecting government pensions. You no longer have the penalties on Social Security. So as far as economy, obviously the data is mixed. Jeremy talked a lot about the economy and how good the data was. Unemployment's still low. We're expecting good economic reports. The analyst says earnings are going to be good. The momentum looks good. One of the things I want to point out, we talked about the buffered index and why I like it so much. I saw that last slide that Jeremy put up with the green and red. And one of the things I noticed is when you have a 20% reimbursement, you see the two tall red columns on that? Those turn green, positive green with the buffered index. The only time you lose money with the buffered index is the three little tiny ones, the very rare things at the bottom. So with the buffered index portfolio, you're going to give up the three highest green columns, but you're able to turn those two other red columns green. And I think that that is really powerful, especially in the current market environment we're having. I think it makes a lot of sense. And the reason that I say in the current market is because The market is expensive. There's no other way to say it. Okay, when we look at long-term ratios, whether you're looking at PE ratio, PEG ratio, you're looking at CAPE ratios, Warren Buffett's favorite indicator is market cap to GDP. All of these things say the market is expensive. It doesn't mean that it's going to crash, okay? And I think that there's a high likelihood that if it did crash, that we would see a huge upswing reversal in a very short period of time, because Trump doesn't want to see the stock market go down on his watch. And he will do everything he can, including turning up that printing press, to make sure the stock market doesn't go down. But if that happens, what is going to happen to all the prices we pay for gasoline and groceries and airline tickets and everything else? Way up. So, you know, I obviously think there's a lot of positive with what Trump's doing, especially with the efficiency in the government and getting rid of some of that waste. But I also think that there's a possibility that inflation may continue and actually come back. And so we're watching that. We want to keep all of the high overweight positions we have on gold, on energy, on agriculture, all the things that do well in an inflationary environment. We're going to continue to hold those because I think that there is a real possibility that inflation, I hope it doesn't, but I think there's a possibility that it comes back. And by the way, that dollar index that Jeremy showed, the DXY, that's compared to all the other currencies. Okay, the dollar's been doing great against the yen and the yuan and all these other euro, all these, but compared to gold, how's the dollar been doing? Not so hot, okay? And so you got to understand that when you're comparing to other currency, yeah, the dollar is the cleanest of the dirty shirts in the hamper, okay? So it's the best of all of the fiat currencies that they're printing to oblivion. So, and inflation's real, and it can get a lot worse. And when you go back over time, it's a big number. I mean, when you think about inflation, I mean, my parents are here tonight. You know what they paid for their house in 1974? $29,500. The Zillow on it is over $900,000 today. Inflation is real, okay? And I think it can get worse. So let's make sure that we're thinking about that with our investments, which we are. And the other thing that I think is really concerning is just the overall price of the stock market. And so here's some statistics that I think are interesting. The United States represents about 4% of the entire world's population, okay? 4%. We're 4%. The other 96% live in other countries. So those 4% actually produce 16% of the world's manufactured goods. We're very productive. We make a lot of stuff. In fact, we're the most productive people in the world. Everyone says, oh, everything's made in China. Well, they have a lot more people, okay? But when you think about the number of people we have and what we produce, we are very productive at 16%. The world's GDP, we represent 26%. World's GDP, that includes all of the service sector as well as the manufacturing. That's about, that's a quarter, 1/4 of the entire world economic output is just the United States, just 4% of the population. And those are really nice numbers, but then when you look at the value of our stock market and you look at all the stock markets around the world, we represent 67% of the entire value of the world's stock markets. That is a big number. I get nervous when I see those numbers, right? I say, wait a minute, that is a big number. We are pretty pricey right now. I'm concerned about the fact that we're so pricey. And even worse, that 67%, if you dive into that, 35% of that entire value is 7 companies. 7 companies. The other 493 represent the rest of it. So I am concerned about valuation. So what we want to do is obviously be very conscientious investing in higher quality value stocks, like the stuff that Jeremy has is value stocks. We want to be in the buffered indexes that have insurance against risk. We want to have guaranteed interest. And you want the 12% with Inspired Healthcare, or if I want it guaranteed, insured, I don't want to lose, well, 5.5% is not bad. Next point will help us out with that. So we've got a lot of other options. And the way you think about this is, you know, risk versus reward. In the event that interest rates are 1% like they were a few years ago, yeah, putting your money at 1%, that's not very good. But today we can get 5.5 or even more going into some of these private placements. So the risk is a lot higher because the alternatives are better. So what we want to do is think about that. And so that's why we've been taking down the risk level on a lot of your investments. You probably noticed we've been selling a lot of stock. We've been buying fixed income. We've been hedging all these investments. Every time that we're doing a rebalance, we're looking for opportunities to protect the accounts. And if we're only up 10% and the market's up 20, that's fine. I just don't want to be in a position where the market's down 20 and we're way down, right? I want to hedge against that because I think it's a real concern. And the other reason I worry about market overvaluation is bubbles, right? Bubbles. This is when you see a big run up. There's a mania. There was a great book that was written in the 1800s called Extraordinary Delusions and the Madness of Crowds. And they talk about various bubbles throughout history that have taken place. In fact, one of the earliest bubbles that we had was actually in Holland. It was called the Dutch tulip bulb bubble. This was a bunch of flowers, literally flowers, that people were selling and buying in a market in Holland in the 1600s. And those flowers, which is a flower, it dies, were trading for the equivalent of over $100,000 in today's value. $100,000 today. Who the hell would buy a flower for $100,000? This is crazy. Were those people nuts? Were they crazy? No, they got caught up. They got caught up in this mania, and that was kind of the first one. The second one was called the South Seas Bubble, which happened about 100 years later, and it's an interesting story, the South Seas Bubble. This is when the Europeans kind of opened up the rest of the markets around the world, in Southeast Asia and in the New World. You had the South Seas Company out of England. You had the Mississippi Company, which was all the French territories. And at the time that was going on, the value of those stocks, they went up 10 times in 1 year, literally 1,000% return. Kind of similar. What was that return on Bitcoin? Oh, 1,000% return. Yeah, same kind of thing. And there was a guy at the time of this South Seas bubble who actually lost the equivalent of millions of dollars on that investment. And he happened to be the smartest guy alive at that time. In 1720, there was not another person on the planet that had a higher IQ than this guy. In fact, this guy was so smart, in his spare time, while he was going to college at Cambridge, in his spare time, he decided to invent calculus. Okay, this guy was really smart. And this guy actually invested and lost millions of dollars. He actually got in initially, made some money, cashed out, which was the smart thing to do. Then what he did is he went back in at the wrong time, lost tons and tons of money. And of course, you all know who that guy is. His name's Isaac Newton, okay? And so you can still be the smartest person in the room and still get caught up in the greed and the craziness that's going on. And of course, we've seen it. There was the railroad thing in the late 1800s. All the railroad stocks went into a giant bubble. We saw in the late 1920s, you had the new companies that had radio. Wow, that's a radio. We got to invest in that. That's a new technology. That went into a giant bubble, crashed in 1929. We had companies in the 1960s, Xerox, Polaroid, the Nifty 50. They all crashed in the early 70s. We had the dot-com crash. We saw that. All these pets.com creating at ridiculous numbers. And of course, we had the real estate bubble, ninja loans. I saw that. No income, no asset, no job. I sold my own house and I rented for several years with lots of money in the bank that I can buy back in, but I just wasn't going to buy into this bubble. And so today we have another bubble. And I know that Jeremy said some positive things about it, but at the end of the day, cryptocurrency is a scam. It's a digital Ponzi scheme, okay? I made a lot of money on it early on because I bought in and I sold it, and I'm not going to buy back in like Isaac Newton did. I do not think cryptocurrency is a good investment. And I think that when you see these cryptocurrencies, and, you know, arguments could be made on the technology for Bitcoin and everything else, that possibly people are going to continue to have value in this. But we recently got a new cryptocurrency that hit $1 billion in market cap. The name of that is Fartcoin. Fartcoin hitting $1 billion in market cap. I would say that buying a tulip for $100,000 is probably a smarter decision than buying fart coin. That's, it doesn't make any sense to me, okay? And by the way, speaking of Trump coin and Melania coin, those are worse than fart coin, okay? No value at all. And the fact that the President of the United States is issuing currency using his position to make billions of dollars on cryptocurrency is shameful. It really is. It's not right. Okay, issuing all this cryptocurrency, and I'll tell you what, Biden, he had to put together an entire network if you wanted to bribe him. He had corporations. He put all these different corporations, shell companies. He had his son and his brother. He did all this stuff to be able to bribe Biden. Trump's going to make it so easy. All you got to do is buy Trump coin or Melania coin from him. He said he was going to make the government efficient, right? I mean, he's efficiently to bribe him, right? So, yeah, I mean, some of this stuff's ridiculous. It's absolutely ridiculous. Trump coin has no value. Melania coin has no value. Fart coin has no value, okay? This is ridiculous. And I think it also reflects a lot on some of the other stuff, the Ethereums, the Bitcoins, the ones that people think actually have value. I am concerned that this is going to be in the future what people look back on and say, hey, that was the mania, that was the craziness. Maybe I'm wrong. Maybe cryptocurrency is going to be the future. I just don't see it. It makes no sense to me. From an economic standpoint, looking at that, I just don't see value. So I know a lot of people really think this cryptocurrency is going to do great, but I really think it's just a bunch of people that are hoping that they can sell it to someone else in the future for more money. That's all it is. I don't think there's anything else there. So those are my thoughts on Trump, the markets, what we see going forward. We're going to keep doing what we're doing. We're going to make sure that we're putting you in the right investments. We're going to be hedging against risk. We're going to stay the course. We're going to keep building really, really good retirement plans that it doesn't matter what happens. Stock market goes up, stock market goes down. Okay, over time, it's going to continue to go up. It's one of the best places you can put your money over long periods of time. You create lots of wealth in the stock market and a lot of the other stuff that we're doing. We've got a lot of other options. The Roth IRA valuation discount is an unbelievable thing. I know some of you guys are doing that already. We've been showing you that. That's how we're turning IRA money into Roth IRA money with discounts. And some of the people here tonight are doing those kind of investments. I think Urban Catalyst, who has quite a bit of business with us, is in the back there. Eric and Elijah are back there. So at the end of the day, we're doing some really great things on tax reduction. So we're going to keep doing what we're doing. And just, I hope that everyone enjoyed tonight, and we're very, very grateful that you're all here. And I hope next year we have another event just like this that we can all come and share and talk about how great the investments have done.